timely, insightful, discussion and analysis of economic trends and markets. From Southern California to Sacramento, featuring business and political leaders, unique field reports. From Orange County and the campus of Chapman University, this is the Chapman Business Report.
And welcome back to the Chapman Business Report. It's our weekly look at business, the financial markets, and a special focus on the regional economies of Southern California. I'm Pete Weitzner. I head up the broadcast journalism program here on the campus of Chapman University, actually a couple of blocks away at the Dodge College of Film and Media Arts. I'm in the building that houses the man to my left, the boss, Dr. Essie Adibi, longtime economist here, also at the Anderson Center for Economic Forecasting and Research, where he and Dr. Jim Doty, the president, have been crunching the numbers. They're upcoming on December 6th, 34th annual economic forecast, both national and regional. So we're on the fourth floor boardroom of Beckman Hall here. And boss, you're getting your final round of numbers, actual numbers, before you do your forecast for 2012. So let's dive right in. The biggest number the last couple of years, of course, is the jobs number. We have very high unemployment, certainly historically high, stubbornly high. And here again, we're still at 9%, but a tick of an improvement.
Yes.
But you tell me, my headline is ho-hum jobs report. You say it's a good October jobs report.
It is not such a bad report. But let me qualify it. I mean, we are generating about 80,000 jobs. That's what we did. And expectation was that we're going to do about 100,000. So
it's not enough to get the rate down. I mean, it went down a tick, and that's because people dropped out.
Exactly. If you want to get the rate down, you have to generate at least 110,000 or more to make a significant dent in unemployment rate. Now, the reason I say the report was not as bad as is portrayed is because, yes, we did 80,000, expectation was 100,000, but the revisions were significant. The previous 2 months got revised each month up by 50,000, and that's very significant because last month we had 103,000, they made it almost 155,000, and 80,000 now. If you average it, that gives you about 100,000 per month.
Not concerned that September's anomalous because you had all the teachers going back to work?
No, the numbers at the national level, they all get seasonally adjusted. That's not the case for local numbers, but for national level.
And in fact, private sector was in the black by 100,000.
Exactly. So what is happening, every indication that we see in August, most economists got really worried that the economy is going to go back to a slowdown and maybe even recession. But it seems like, at least based on the numbers that we're getting for September and October, both job creations are basically according to the expectation, and more importantly, consumer behavior is amazing.
We'll get to that in a bit. Let's just run through jobs. Now, the Federal Reserve says at this rate, or their forecast is by late 2012, the best we'll be at is 8.6%. Is that going to jive with
that makes sense.
That makes sense.
That makes sense. Maybe a little bit lower, a little bit higher, but basically what it suggests, I mean, let's look at the number. We are at 9%. So by the end of next year, that means almost a year from now, 8.6%, that's extremely high, which means they're worried about job creation, same as private sector. I mean, private economists, such as us, that we're worried about job creation. See, unfortunately, what's happening, very many firms, what they have done, they're making tons of money, but they're not hiring and spending it on capital goods and equipment.
They were pretty good again.
Yes, it was very good, very good. And the stock market should have been much higher if we didn't have all these external shocks. So economy overall, I would say we are moving in the right direction like a turtle, very slow, and that's unfortunate.
If someone was to say their goal was 8% by the end of 2012, perhaps that might make things good for someone who might want to hold or win a job. They say we'd need 263,000 jobs a month. We won't get that.
We're not going to get that. There's no way you can get an average of two. That means almost 2.6 million job creation.
What would have to happen for us to do that?
GDP has to grow really fast.
And what would drive that?
That's the problem. See,
GDP, consumers are starting to spend.
Yeah, but
cars.
But 2.5%, 3%. I mean, typically when we were coming out of recession, when we were coming out of recession, consumers were spending what, 6%, 5%, 7%. And if you look at GDP number, that we got for third quarter was 2.5%.
Right.
Which, by the way, that was
good.
exactly.
I call that one an upside surprise.
Yeah, that was exactly what we expected, though. If you remember our previous show, we were talking and
because
we were
of the
expecting
consumer
to.
and capital investment.
And capital investment. And export did okay, too. Fourth quarter is going to be 2.5%. Next year, probably it's going to be in the same range, 2.5%. And that's not enough to really create demand. Look at it this way. If you're running a business and people are coming and buying from you 2%, 3% more, are you going to rush out?
With inflation.
Exactly. Are you going to rush out and hire people? No.
Especially when I know in 2014 I've got a mandate coming about health care.
We can talk about that in one show.
But that's also holding back.
That is holding up. And uncertainty about taxes. We still don't know.
As we record this, the super committee is.
The super committee can come out.
Democrats want to raise taxes.
Yeah, and it is possible that some sort of taxes are going to increase, but nobody knows which one.
The push is to compromise here.
Yeah, so the question is, again, going back, where is that oomph is going to come to produce 260,000 jobs on a monthly basis? I don't think that's going to happen based on a GDP forecast, because GDP is basically what it says is how much money is spent in the country by consumers, investors, foreigners buying from us, and government sector. And we know government sector is going to be under pressure too. So you can't count on consumers. There's still deleveraging. The 2-3 percentage point that you're seeing increases in consumer spending or car sales, for that matter, is all pent-up demand. People who are employed postponed their purchases, and now they're making up for it.
The number of consumers who are more than a month behind on their credit card never been so low.
Yeah.
Which is good long-term.
It's a good news, but it means they're not spending.
It means they're not spending.
They're not
but
spending.
They are buying cars.
It is very unfortunate that we want everybody to save, worry about the future, but at the same time, we want them to spend right now to lift the economy.
Right.
So it's kind of a contradictory.
Yeah. Although, when they start to see how much these apartments are going up, which they are, they might decide that the tax benefits are worth it to buy a home. Okay, let's look locally on the jobs front. Good number for Orange County. Rate drops to 8.6, 5,700 jobs. We're one of the lowest Orange County is in the state.
In the state, correct. But be careful again. When we look at the Orange County numbers, or Inland Empire, or even up north, San Francisco area, these numbers are not seasonally adjusted. The boost that we got for Orange County employment, what was it, 5,700?
Right.
It was mostly teachers going back.
Yeah, but you had professional and business services.
But there are some sectors. Interestingly, construction is generating some jobs, which is good news. So more or less, again, the same picture. Paint the same pictures that is happening at the national level, at the state level, and the local level. Yes, we're creating job, but the pace of job creation is not as strong enough
Certainly
to
not
really
in Los
bring
Angeles.
Los
Inland
Angeles.
Empire's 13.5%.
But
statewide,
look at the Inland Empire. What was it? 13.5%. But you know what
combining
it was?
Riverside and San
Yeah,
Bernardino.
what it was
There's a
at
little
peak,
improvement.
almost 16%.
Right.
So we're moving in the right direction, but not at the pace that we like to see it.
All right. Well, you mentioned the importance of the consumer, still 70% of the economy. We know another trunk in GDP. Government certainly not helping; they're hurting.
Yes, state and local government.
Right.
Federal government is still spending.
Yeah, they're hiring 60,000 agents to enforce Obamacare.
Is that what it is?
60,000
right now?
Yeah, absolutely.
I didn't know about that.
You didn't know about that?
I didn't know
enforce
that.
the individual mandate.
Well, it's
60,000
They're
jobs,
creating
I know.
jobs. but next.
I hope you don't have to deal with any of those guys.
Next year, if the super commission that they put together starts cutting spending, then it means even federal government is not going to be a big spender. So we're down to investment, consumers, and export market. And the export market now is becoming a little bit iffy.
The dollar is firming?
Dollar is firming. Europe is dipping into recession.
Right.
All of these uncertainty about Europe's problem. What's going to happen to Greece? What's going to happen to Italy and Spain? What is causing basically is significant slowdown in the region. The only economy that was doing very well was Germany. Even Germany now growth rate is about 0. So if Europe really goes back into a recession, depending on how bad it's going to be, that's going to affect us, no question, in terms of our export.
Well, you just watch what the financial markets do every day. It all has to do with how they weigh the news coming out of
and
Europe.
financial market, to be honest with you, doesn't care that much if economy goes into recession in Europe. What they're worried about is the banking system. We know that they came up with the package, to solve Greece's debt problem. Then we heard the Prime Minister now wants referendum.
Then he doesn't want referendum.
Then he doesn't want. And then all eyes are now on Italy. You know, what's going to happen to Italy? They're paying
third biggest economy in Europe.
They're paying almost 6.5% on 10-year bond. You know, they're borrowing.
Right.
And they have to refinance massive amount of money next year. And the question is, if the market starts looking at them that they're going to be a problem, then the interest rates on those borrowing are going to be so high that it's going to create the same situation as Greece. And you know that they came up with this fund, you know, European
stabilization
and security fund. Yeah, that's basically what they're doing. Exactly. What they're doing, they put some money there, close to almost 400 billion euro, which is almost $600 billion. And they're trying to use that money to shore up, you know, and buy some of these bonds that are issued by Greece and maybe Italy, but the amount of money is not enough. And they were hoping to raise this sum to get some money from China, get some money even from US or IMF, and it looks like they're debating that issue.
China might be in.
China has an interest to be in there, but you know, nothing comes free. They want to get something out of the deal.
By the way, China keeps growing 9%.
9%. That's a good news. That's a good, because see, again, if you look at our export or international trade, if Europe is going to get weak, South America is doing okay, Canada is doing okay, Mexico is doing okay, but then Far East, China is a big gorilla, and we know Japan is not growing that fast. Right. So Chinese growth rate is extremely important for world economy, and they're growing as you mentioned. What is it, about 9.5% now?
From 9.5 to 9.1.
I mean, some of those numbers are really, you know, you can't trust all the numbers that are coming out. But basically, what it suggests, whatever they were doing, now they're doing a little bit slower.
Right. And getting back to the consumer, okay, consumer confidence was weak in October.
Yes.
Weakest it's been in a couple of years. And yet, and maybe it's just out of necessity, we continue to buy cars at a rate of 13.3 million, and that's very strong. All the domestic makers, important to taxpayers, the GM does well, and they were up 2%, Chrysler was up. Locally, Hyundai, who's based in Orange County, up 23%. They've already sold in October more cars than they've ever sold in any other year.
Yeah, they're really coming strong. They're producing better cars, better warranty, and they're competing with their price system. You know, they're selling more. But going back to your issue, going back to the issue. Consumer confidence is kind of a tricky numbers. You know, we ask people, what do you think about current condition? We do the same thing for California, and future condition. And they say, oh, current condition is very bad, future condition doesn't look that rosy. But at the same time, they go and buy the car. So there is not a strong correlation between consumer confidence and consumer spending. However, you alluded to one important point, and that is the pent-up demand. That is, there are certain things that are mechanical, and if they're mechanical, they break down, and they have to be replaced. See, car sales was horrible in 08 and 09, so 10 and 11, more or less, we're making up for it. Now, the question is this pace going to continue into the next year, going over 13 million, you know, car sales? That we have to watch.
Even some
That's the big
car
concern.
Sales are picking up.
Yeah.
All right, let's look at some other current numbers, gauge these. Home builders index, it's still horribly low, but at least it tipped up in October.
Yes.
That's home builders who see folks coming through the showroom.
Yes.
Now, we know starts were great, much better, but that's all because of apartments. So a lot of multifamily building going on. Rents are going up.
Yeah.
But do you see any signs of life then in new home sales?
I mean, any sign of life, yes. But is it significant? Is it something to get excited about? No. What's happening, basically, this is happening, by the way, locally, too. If you look at Orange County, LA County, Inland Empire, we're seeing some pickup in permits that is building activity. But as you said, they're all in multifamily units. Why? People who have lost their job, you know, or their home got foreclosed or short sale, they're leaving and becoming renter, and where do you rent? In multifamily units. So lots of builders are basically building to satisfy that segment of the market because of a higher lease rate. But what's going to happen, you know, down the road, big mistake is rents are going to go up, 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 and eventually, maybe 2 years from now, people realize, gee, you know, they cannot handle that. They better buy a home, and it's a better, you know how much you pay, and you get the tax benefits.
And you're just going to have to be patient to develop equity. Now, we haven't had yet a federal proposed program. There have been a lot of economists that want it, and politicians, to reduce mortgage principal. But we have a new refi program,
Yes.
which is a problem, right? Because people don't have money to spend. They're underwater.
Yes.
So now they're going to increase the amount of folks who are underwater. It used to be, oh, you could owe 125% of what your home is worth. Now it could be any amount.
Yes.
I could have a $300,000. I could owe $600,000. My home's only worth $300,000. If it's backed by Freddie Mac or Fannie Mae, I can refi.
Yeah,
That's a good thing.
It is not a bad idea. Part of the reason, again, this is not going to help housing market, but it's going to help homeowners to stay in their home and save some money, you know.
Right.
And what they're suggesting to do, as you said, is that, but you have to be current, by the way.
Right.
There are people that, you know, they're making their monthly payments and their home value is, let's say, 70% of their loan,
Right.
and is still making monthly payments. So these are, you know, people who want to stay in that
Trying
house.
to cajole them through policy to do the right thing.
No, you're basically telling them, okay, we understand why you cannot refinance because your loan amount is way over the price of the
Right.
home. So what, as long as you're making monthly payment, why not? We reduce the interest rate. Of course, remember who's paying for it. You said Fannie and Freddie, those loans should be held by these two institutions.
Right, and that's why they asked for $6 billion more.
Which it means their earning is going to go down. I mean, if the current interest rate on those mortgages, let's say average is 6%, now it has to go to 4%, so the earning, in a way, taxpayers are paying it. But is this going to revitalize the housing market? No.
Might help the economy.
It's going to help the economy because these people, rather than writing a check for $2,000, now maybe write a check for $1,500, so they have $500 to spend. So most economists, in a way, they say that's not a bad program. It might help a little bit the economy overall. But all economists that I've heard, they're against reducing principal outright. And that's a big mistake. And you know that we're talking about
As
that.
are you.
Yeah, of course. That's a
Moral
that's
hazard.
moral hazard. That's the biggest mistake. And how would you distinguish between your loan and my loan? You know.
I agree. Mitt
Yeah.
Romney, we know, is against it. He said,
No, it's a
let-
big mistake. It's a big
let
mistake.
things settle.
Yeah.
And to his credit, the president has not put that on the table yet.
No, I haven't heard it
You're
yet.
concerned about inflation.
Yes. We've been concerned about inflation last year when they started
4%
quantitative
annual
easing.
rate almost.
You know, when they
Right.
did quantitative easing 2, which was printing another $600 billion, oil prices went up, gas prices went up, and then
they're
commodity
still going
prices,
up.
sugar, wheat, corn, everything went up. Now, the good news is, on the oil front, we got a little bit of a relief from Libya. It looks like they're producing. They're bumping up production. So that should help us
Do
a
you
little
expect
bit.
we're in the mid-90s now?
We stay about the same,
Okay.
unless China slows down. China is a big factor affecting oil prices because they're a big consumer of
If they
oil.
slow down, then oil prices will
Oil
come
prices
down.
will go down, sure. But having said this, Federal Reserve more or less in the past and now ignores changing prices of energy and food. When they look at inflation, they take those two out and they say these two are too volatile.
Right.
I don't like it. I think it's a big mistake, and I think slowly they're going to pay attention to overall inflation, which includes those two factors. I mean, when you take those two out, you come up with like CPI for people who don't eat and drive. I mean,
Exactly.
it doesn't make sense. So I think looking at the inflation rate, it's not going to go at the rate that is going. What is it, 3.8% or year over year? I don't think it's going to go at that rate, but it's going to stay at the elevated level, which means Federal Reserve has to be careful on their next step, because some people, you know, they're asking them for quantitative easing 3, which means printing even more money. I hope they're not going to get there.
Let's real quick gauge of corporate earnings. We'll cut through a swath of different industries. Allergan's biggest company here in Orange County in terms of market cap. They actually lowered their forecast, which is rare for them. And you can jump in any way here. The
No,
oils?
Allergan, the problem obviously is, you know, selling what we call cosmetic,
Right.
you know, pharmaceutical
Botox
products, and people are pulling back there.
implants.
So that's what's impacting them. Yeah.
Chevron, ExxonMobil, this will really please the Occupy folks. We have a story on that coming up. Gangbuster numbers.
Of course, the oil prices are high, and you know when you have your oil company, you have oil well there, the prices go up, your cost doesn't change, so it all goes to the bottom line.
Texas-based Whole Foods.
Yeah.
Anyone who's been in a Whole Foods, referred to his whole paycheck,
They're doing well.
up 30%. What does that
great.
say?
It's competition again. See, they probably have better prices, better marketing.
They don't have
and,
better prices. We all know that. No, they're expensive.
Are they? So maybe they have healthier food, or
The techs, Qualcomm, up 40%.
oh, that's no surprise. You know,
They sell a lot
Qualcomm
to
is Apple. I mean, Apple is they're the major producer of the chips there, aren't they? I think Qualcomm is
Absolutely.
producers. Yeah.
As is Broadcom, who's also
Exactly.
doing well. Wet
Exactly.
Seal, just throwing one retailer, but I've seen others. be told, is not doing that great.
No, it's a huge competition
Nordstrom not
there.
doing that
It's a
great.
huge
Tiffany's
competition.
not doing that great.
It's huge competition. You know what's happening? Consumer spending, the pie shrunk. I mean, it's growing only by what, 2-3%.
Amazon didn't do
and
that
all
great.
of these guys are trying to grab, a smaller share of the pie. But having said this, I think the Christmas season is going to be better than most people expect.
Okay, well, we'll get to that in our forecast preview show. I know we can only give a little away. And hang out. I want to get your gauge on this Occupy movement. It actually, believe it or not, came to Irvine. As we go to break, here's another look at some other local earnings reports. Back again with the boss. We'll look at the Occupy Irvine movement. Welcome back to the Chapman Business Report. Time for our great student feature stories. You know, of course, the Occupy movement, which began on Wall Street, is all around the world now, and it actually is in Orange County. Boss, are you a fan of the Occupy movement?
I don't even understand it. Sometimes I think they are saying, banks are no good. Sometimes they're going after the top 1%, and they say we should tax them. So I'm not exactly sure what the message is there.
Well, here's what the message was in Irvine. It came to Irvine, and TV reporter Jake Thompson has that.
If you want to end the wars, take back the money from the damn banksters.
What began as a small group of demonstrators has now grown into an unprecedented movement. The Occupy Wall Street protests have drawn people from all over the country to New York City to express their anger towards a variety of issues, from corporate bailouts to congressional fiscal irresponsibility. Camping out in the financial district of Lower Manhattan, tens of thousands of people have created a modern-day Hooverville. But it's not just New York anymore. Last Saturday, a large group of protesters met at the Irvine Civic Center, armed with chants, signs, and frustration.
Just standing up in unity, in solidarity with the movement of taking back our world.
Show our solidarity with Wall Street and our determination to make changes. And the only way to make changes is for the people to get out and make noise.
There would be no 1% if the 99% didn't do all the work.
The system plays on the rich man's team, and it's not here for us.
The 99% of us, we're increasingly being forced to work harder and harder. And what do we get in return? Less and less and less.
To me, democracy is everybody having a say, everybody having a real say in what we want. What we want is equality.
For me personally, I'm here to end corporate greed. I'm tired of the top 1% controlling everything. I'm tired of corporate America.
Show me what democracy looks like! This is what democracy looks like! Show me what democracy looks like! This is what democracy looks like! Show me what democracy looks like! This is what democracy looks like! Show me what democracy looks like! This is what democracy looks like! Show me what democracy looks like!
Behind me you can see some of the protesters now chanting things like "We are the 99%," the slogan of the Occupy Wall Street movement. Though every single one of these protesters has a different reason for being here, their protest can all be summed up with one simple sentence.
I'm mad as hell, and I'm not gonna take it anymore!
I'm mad as hell! I'm not gonna take it anymore!
Jake Thompson, Chapman News.
Now you know what they're saying. They're mad as heck, and they're not going to take it. And they're not going to take it anymore. Well, a lot of folks say the anger.
Do they want health care, free health care, or do they want higher taxes on the rich, or they want to tax all the banks, destroy them? I don't know which one.
Some say their anger either should be more spread out and should also be at Washington,
I
D.C.
don't. But they should go to Washington, D.C.
Interesting to see how strong it stays, especially through the cold winter months. The boss, Dr. Essia Dibi, as always, wonderful insights on the economy.
Thank you very much.
Good luck. I know you're burning the midnight oil these days. Good luck on the forecast. We'll be back again with you in another couple of weeks. And as always, the Jeff Cole Productions, Chapman Class of 2001, and his great crew, Ryan Westra, Dan Duran, and Haley Quarteroni, that put on the Chapman Report. We had to come inside. It does rain in Southern California. See you again next week on another edition of the Chapman Business Report. I'm Pete Weitzner.
Funding for this program was provided by Chapman University.